You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of The Options Playbook. All right, well, we usually start by looking at last week's trade, but honestly, nothing's really happened. We talked about a back spread in the VIX using puts, looking for a downturn in the VIX index, the actual VIX index. We went out quite a bit in time. So actually, this trade might be more interesting to talk about at the end of December than it is right now, because our forecast was what we'd ideally like to have happen in that trade is that the actual futures contract that represents the January 20th expiration date would get down below the 19 level. We would ideally like it to go beyond that, but at least get to that level and hopefully get there sooner than later. Right now, we are taping Options Playbook Radio. It is December 9th. The markets are closed. The VIX closed today up a little bit at 2227. A little bit higher than it was last week. The futures contract is basically trading right where it was. Last week it was around 24, and guess what? That January 20th futures contract is still trading there. So the back spread is basically trading for what it was trading for when we put it on, a small net credit to the account. So we just stay the course. So we are in December, by the way. I did mention that we are taping on December 9th. So we're getting to the end of the year. A lot of times when we're getting to the end of the year, one of the sessions I like to talk about, which I don't talk about too often, only because it's a fairly boring strategy to talk about, but I always like to think about selling some calls on some stocks I might want to get rid of before the end of the year. I might want to get rid of them because I want to sell them because I have a loss and I need that benefit for my taxes because I've been so quote unquote profitable, I say with a smile on my face this year, or I might want to sell stocks just in general that are up because I don't mind taking that tax benefit this year. So how can I do that? I just might pick a couple of my stocks, whichever my goals are, and look at selling some calls. So look at bringing some premium in. There's still a lot of premium to be had out there, and that's one way to manage your positions as you go into the year's end. Now, it is the 9th. We have 3 weeks. In 3 weeks' time, it would be the 30th, right? The day before New Year's Day Eve. And so that still gives you plenty of time, especially with vols the way they are in the marketplace and what's going on overall. All right. So think about that. It's very simple, very straightforward. You have 100 shares of something, you have 1,000 shares of something. Maybe if you have 1,000 shares of an underlying stock that's done well this year, maybe you just go on out and sell 5 contracts against that position. Just kind of use it as a way to maybe rebalance your portfolio. So I always like the concept that doesn't get talked about a lot when you're looking at covered calls of not selling covered calls on the entire position, just selling it on shares that you are okay with getting called away on, and using it as a way to actually sell the stock at a higher price and actually bring in some income along the way, bring in some cash. Now, today, I want to do another FOMO trade. Not that long ago, we talked about JETS, JETS, and looking at buying a longer-term in-the-money call option as a fear of missing out, and that we want to allocate some capital maybe going into the year end, but people are still definitely nervous about the marketplace. We finally got the VIX index recently to stay below 25%. Right now, today, as I mentioned, it's 22.27, up $1.59 on the day. So once again, still very volatile on non-volatile days. I mean, we had the SPX down 29 points, but that's less than 1%. Not really a huge move. The Dow barely moved at all. It was only about 1/3 of a percent that moved overall. The Nasdaq did come down a little bit more than most. That Nasdaq index is down almost 2%. But we're having a lot of divergence between the actual indexes. And one that's kind of odd is the Russell 2000. The Russell 2000 recently has been leading the way in this marketplace. So when we see the Russell today, it was down $1.40 on the day, maybe just a smidge over 1% just in general. So, but overall, that index has been leading the way. So talk about mixed messages in that. People are usually trepidatious to be in the small caps, which the Russell follows, when there are concerns about recessions. Everything that the coronavirus is driving on a high unemployment overall. But then we turn around, we look at the VIX index, and the VIX index is stubbornly staying above that 20 level. So a little bit of mixed messages there. You would expect hitting all-time highs in the SPX and the NDX. And a lot of these index, the IWM, that's the Russell 2000 ETF, hitting new highs in all of these. You would think that you would see the VIX actually just kind of start to come in and go back towards its mean. All right. So how can we combat this? If we are nervous, which the marketplace is telling us that we are by the levels of the VIX, once again, then how can we allocate capital and feel fairly comfortable about doing it? How can we manage risk? And one of the biggest things about option trading that a lot of people just don't seem to comprehend is that options were invented to try to manage risk as opposed to try to speculate on market movements. I know that's contrary to a lot of popular beliefs, but options have been around for quite some time. And where they really started getting interesting was as a need for farmers to protect their crops and fixate prices that they can sell their crop for, i.e. the futures marketplace. Then there's options on it that allow you to fixate a price on the downside, fixate a price on the upside. But even call options a lot of times can be used as a way to protect yourself. And we've talked about a couple of those recently, like as I mentioned, JETS is one of them that we looked at. I also think by looking at the chart, we were talking about Boeing on the Ally Invest midday market call, which is part of the Ally Invest educational platform. I do that show every Tuesday at noon Eastern time, and we do it live. Right now it's done via WebEx. We're going to be switching it over and doing it to Zoom. But with that said, when we were looking at Boeing and kind of talking about where the chart is at in Boeing. So we just basically came back and set a new high in Boeing since the March downturn. So everything is really post-March downturn and after March downturn. So that's really the way most people look at the marketplaces nowadays, because they're totally different worlds as far as the markets are concerned. And a lot of the airline stocks, a lot of the travel stocks, there's a few industries that were out there. I think we've talked about the banks before. A lot of them haven't even gotten back, actually still quite a ways away from where they were before the pandemic was announced. So Boeing happens to be that type of underlying. And they've had some good news. A lot of people were playing Boeing. Boeing we've talked about a lot because way back in the day, we looked at a lot of long straddles in Boeing because there was so much news about Boeing. Boeing has actually became boring news-wise compared to where it was back in the day when it was the only thing that anybody had to talk about. And they kept talking about their MAX planes and when they might fly. And, of course, they had the horrible situation of a couple of plane crashes that were caused by their software and everything to go along with it. So you were just kind of looking for news headlines to blindside the stock, and we did receive a lot of them. So our long straddles, the volatility just wasn't as high as we thought that it should be. And when you get major news events, that stock would really make wild swings. Now we're kind of back to a situation where we have a little bit higher implied volatility in the marketplaces overall. We have Boeing actually announcing that their planes are flying. American Airlines is actually using a MAX plane on a daily route, and they've received some orders for some new MAX planes. So the stock has actually made an upturn. As of today, when we look at Boeing, it is currently trading at $231.80. It was down $4.77, or about 2% on the day. Now, that's a very interesting level overall, and it'll be interesting as far as the chart is concerned. Boeing seems to try to be deciding, do I want to go up or do I want to go down? Now, Boeing, before the pandemic, was way up over $400. The books have definitely changed on it, and a lot of their clients are struggling with bankruptcy at this point in time, but economy's kind of getting back on their feet. If you want to participate in an underlying like this, it's usually a little bit too late after all of the stimulus and bailout and the companies get back on their feet. You want to think about getting into a position prior to all that news and prior to that information, but there's still a lot of risk. So how can we do it? Well, if we're looking at just buying in the money option contracts, if we look at the option chain to try to get us out basically for the next couple of months, see what happens we already have vaccines that are going into people's arms across the pond over in Europe. And we're going to have a lot of news. It's going to hit this marketplace over the next couple of months, and we'll see what will happen. And because of that, we might want to think about just in general using options to manage the risk on the downside, but still allow us to participate on the upside. And one of the ways that we can do it is we buy in the money longer term options. So if we do that at this point in time and we go out a little bit further in time, so in this instance, we're going to go out to the June expiration date. That June date is 191 days away. A lot of times we like to go down and look at a deeper in the money option contract. In other words, we'd look at an 80 delta or so, but these are fairly expensive options. But if you think about it, Boeing is a $231 stock. So you're talking about $23,100 to buy 100 shares of it. So we want to look at something where we can manage our risk, and we can do this for a okay loss point, if you will. So in this instance, if we buy the 72 delta with that expiration, that option contract is trading right around $51. The ask price is $51.80. Let's just call it $51.50. Say you could fill somewhere in the midpoint. As always, when you're trading deeper in the money option contracts, one of the problems is that they're definitely not as liquid as the underlying stock. There is a lot of open interest on this contract, and in general, there's just a lot of interest in Boeing overall. So you got decent option volumes, decent open interest. But if I do that and I look at this trade, well, now if I do get that at the midpoint, which would be 51.50, that would be $5,150. Quite a bit less than paying that $23,180. Now it's still it's approximately 22% of the stock price, so that is my risk, and 22% is a big number, but we are still playing some volatility here. So these option contracts going that far out in time are trading at about a 51% implied volatility. So there is still some juice in this, and because of that, we'll think about actually doing what we were mentioning earlier. Just look at selling a call against that position. And if we do that, there's going to be some premium in the shorter term option contracts, and that would actually be called a fig leaf inside the options playbook, or also known in more venues as a leveraged covered call, in that you're buying something that acts like the stock, but you don't own the stock. So the term fig leaf came from the fact that you're kind of covered. You have something, you are buying a deep into money option, and you got a high delta, you got something that acts a lot like the stock, but you don't own the stock. So if you're selling the shorter term options against it, you want to make sure you don't get assigned on them. You want to manage that position. There's a lot more that's involved with a fig leaf than just buying the stock outright and selling a call against it. Okay, so the official paper trade, and as always, is not meant to be a recommendation, but we've been talking a lot about just finding areas where there's been some weakness and how can I participate in those areas. Maybe it's an underlying stock, maybe it's a specific sector like jets, and you're just using the option contracts on those ETFs that track those sectors. It's another way to look at it. But in this instance, one of the big things about looking at a Boeing trade is understanding that option pricing, and that if I put this trade on, Boeing's at 231.80, and by buying the 200 strike, it makes it easy to talk about. The math is simple, right? If we think that underlying stock is going to go up in price, we have a little delta to help us out. If it goes up 1 point, delta says that our $5,150 option contract, if we buy one of them, should go up about $72 or about 72 cents. That's what the delta is telling us. Now, one thing that I do also like to look at, especially when I'm talking about buying leap options as an alternative to the stock, is, well, what if the stock came down to the strike? Where would this underlying be trading at? And what's nice is if the underlying stock does go up in price, we will get longer Boeing. In other words, our delta will increase, and you can think of that as you are actually getting more. It represents more of the stock. Eventually, if the delta gets to 1, it's basically moving 1-to-1 like the stock. Now, you do have an expiration date, and that's always kind of a bummer in the options world, but we are 191 days out to that June expiration. But if I were to do this trade, I really would just want to talk about the management of the risk and try to give you realistic expectations. Now, we said overall that we're paying about 22% of that stock price as opposed to buying 100 shares of that underlying stock. But I don't want to risk that 22%. I'm hoping that if we did get this breakout recently, that breakout continues, that it doesn't come back and test where the resistance now becomes support, and that it bounces off that support line and it continues on up. So if it did come down anywhere to the 200 level that I own, that becomes an at-the-money option contract. And guess what? On the downside, it goes against you slower than it does than it benefits you on the upside. And that's one of the value, they say, your mom always said you get what you pay for. And that's one of the benefits of paying up for option contracts. So if it did come down to that 200 level, how might we know approximately what that option contract would be trading for? And in this instance, The easiest thing to do without using calculators and kind of looking at where the market's at right now, so this would be kind of a short-term situation, is just to look at the at-the-money option contract right now, right this moment. So if the stock right now is at 231.80, so let's say it moved 30 points. If it moved 30 points, that underlying stock would be at 201.80. The 200 strike call option would be just a little bit in the money in that instance, right? Because we'd have the right to buy it at 200, stock's at 201.80. But guess the reason why I bring it up, though, is that what is the 230 call trading for right now? If we look at the most at-the-money option contract right now, it would make sense to think that if the underlying came down, that option contract in the near term, it would be a near-term situation because we're looking at a snapshot as of today. If it came down, it would give me some hint as to what I might be able to get out of this trade for. And right now, that 230 strike call is trading right around $36. So if I put on this trade, I do have a total risk of, we called it 5150, so $5,150. But if the market were to go down 30 points tomorrow, if that were to happen, I would just look at getting out of the trade. And hopefully we could get out at around that $36 level. Now, as expiration approaches, as weeks go by, that number will change. The market conditions will change. Implied volatility can happen, those type of things. But it just gives you an idea of what your true risk is on this trade. So we would hope that we would put it on. The market would go up. As the market goes up, we get more delta. We get more stock price representation. And then if the underlying market comes down, we're going to be very leery of it getting to an at-the-money option contract. As you always know, as I'm sure most of our listeners know that are out there, that's where all the premium sits. That's where all the juice is. And as it comes down, we take advantage of that juice. And then we just get out and sell that at that position if it were to come down to our strike. Fear of missing out, we're doing this. We're only allocating about 20% of the capital as opposed to buying 100 shares of stock. We're going to go out 191 days. We're going to go out to that June expiration date. So we're going to have a lot of news that happens over this summer and with everything that's going on in the world, and we'll see. But in general, let me know what you think about buying in the money option contracts as a substitute for buying that stock and using it more as a risk management tool as opposed to thinking of it as a speculation tool. That also means that if I was planning on buying 100 shares of Boeing, right, I would really just be buying one option contract. I'm not going to take the savings and go out and buy 4 or 5 of these things because then I'm using it as speculation as opposed to using it to try to help manage my risk. All right, that's going to be it for this episode of Options Playbook Radio. If you have any questions, please email them to me at theoptionsguy@invest.ally.com. And I've been tweeting a lot more, so please follow me at Twitter. You can find out about all my educational events. Usually I put a link to each and every one that we do on all the different platforms. You can find me very easily. It's just at Brian Overby. And that'll be it for the show. Thanks for listening. We'll be back at the same time, same place next week. Until then, may all the options you bought finish in the money, and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.